On this episode of In the Know, we certainly discuss this employment report, which was a boomer, and the confusion that it's causing, and give you some bearings, at least through our eyes, as to what's going on out there in the markets. Greetings, everyone. It is Employment Friday, and what an Employment Friday this is. Beautiful employment report. This economy is moving into boom territory. We've been talking about this for a while, but the markets are plummeting. What the heck is going on? Well, we think we have the answer. I think it has to do with Kevin Warsh, our new Fed chairman, who is not saying anything, at least not yet. And maybe he won't until June 17th, which is when the Fed announces its next interest rate decision. So we've got roughly 12 days. I do hope he says something in the meantime. He may not. But if I understand who he is, he has much more of a supply side policy bent. And he does not believe that strong employment and strong growth is bad news. In fact, people who do believe that adhere to something called the Phillips curve. When growth goes up, they think inflation goes up as well. And that's just not true. In fact, the most vibrant growth periods have been associated with much lower than expected inflation. Why? Because of productivity. And I think the same thing is going to prove true now. But we have a bunch of hawks on the Fed, and they may not be talking as much as they did under Chairman Powell. And I think Kevin Warsh is going to stymie that a bit because it just causes volatility unnecessarily. But they are out there whispering. And so a lot of people are afraid they're going to make another interest rate decision that is not conducive to growth and lower inflation. And believe it or not, that would be higher interest rates. Now, we think that where this all will end is a clear understanding, and we'll show you in charts what's going on. It's clear what's going on, that productivity is driving this economy, and that inflation is going to break to the downside. And if the Iran war is settled anytime soon, and we're beginning to see oil prices peak and come down already, so there is that anticipation, that inflation will probably go negative sometime this year. And that will be, first of all, the oil price unraveling. But second, the impact of productivity, enabling companies to actually lower prices. And we are seeing some companies lower prices. I know I featured here a couple of months ago, Frito-Lay, which is owned by Pepsi, cut the price of some of its products by 15%. And we're hearing other companies like Walmart and Costco saying that they are not passing price increases through as much as one would expect, because they are seeing efficiency gains and productivity, thanks in large part to AI and robotics. So here we are. I think the charts tell a very good story. And hopefully Kevin Warsh will be looking at this and these charts as we pull them together and weigh in on them. So I'll start with a Kalshi chart. We're learning a lot about what to do and what not to do in terms of phrasing questions or statements. And in this case, we realized that federal deficit to GDP falls below 5% for fiscal 2026. Our intention, and again, we have to get better at wording these things. Our intention was to say that the federal deficit to GDP ratio falls below 5% at any given point in fiscal year 2026, whereas this effectively reads on average for fiscal 2026. So we knew that it wouldn't be on average, but we do believe that it is going to drop below 5% before the end of fiscal 26, which is September of 26. And let me show you a few reasons why. So in other words, we're learning, we're going to perfect our ideas in terms of how we state them. And, you know, this is very important. Any of you who are focused on Kalshi and prediction markets will know that there was a big controversy having to do with Polymarket around Michael Saylor's first sale of Bitcoin from MicroStrategy, or Strategy as it's now known. And there was a big hullabaloo. You can read about it, but it had to do with, you know, the explanation of exactly what the statement was trying to say. And again, we made the same mistake. So it will not drop below 5% for fiscal 2026, but here you can see why we think it will or could before the end of this fiscal year, September. You can see that there's been a bit of an improvement in the last month to, I believe it's minus 5.3%, roughly around there. Despite here you see corporate income taxes down dramatically because of the accelerated depreciation in last year's tax package. That's accruing to the benefit of corporations who are now able to invest much more in this new AI age. But this should have hurt the deficit, right? As should this. This is individual tax refunds. They are up, you see in the black line, they are up roughly 17% year over year. So that also should have been a drag on the deficit. And yes, yet it improved a bit. Now, we'll get back to why we think it's going to continue to improve. I gave you a hint, not just a hint. In the introductory statement, I basically said, you know, this economy is booming, and that's what's happening here. And that's what we thought would happen. So here on the dollar, how high will the DXY get this year? Again, the way this reads, it could be on average for this year. What we meant was any time this year. Now you can see Kalshi is betting or is predicting 101.9, which is down from where it was, roughly 103. But you can see here where the dollar is. It's a little above 99. So Kalshi, or the prediction markets, are expecting an appreciation in the dollar, despite all of the narratives out there that the dollar is in a death spiral. I mean, that's a bit of an exaggeration, but a lot of forecasters predicting the dollar continuing to go down, and you can see here it is actually stabilized, continuing to go down because of whether it's the end of American exceptionalism or our twin deficits, the budget deficit and the trade deficit. But if we are right, the dollar will turn up decisively this year as the impact of the tax package, which started last year, filters through into booming economic activity, and the returns on invested capital in the United States continue to go up relative to those in the rest of the world. Now, one other thing I'll say about the dollar here, high energy prices typically help the dollar, and so it should have stabilized, if not have gone up, because oil is priced in dollars for the most part. So that didn't happen, and we have to recognize that. But look what is also happening on the other side of that. Here are the holdings of Treasury securities by countries in the world. We have China, Japan, and India, and we also have Turkey. Turkey's in the green, and I saw the headline a couple of weeks ago which said, Turkey has effectively drawn down its treasury reserves to almost nothing as it's been supporting its currency. So what's it doing? It's selling treasury securities, getting dollars for those, and then selling the dollars and buying Turkish lira to try and support the currency. Well, they're almost at the end of that road, and they're also selling gold, as is Japan. And I'm sorry, Japan has not been selling gold. Japan has been selling treasury securities to support its currency. It does not want the yen to depreciate below 160. Well, it's kind of below, really is above 160. So that's 160 yen to the dollar. So we've been getting more and more yen per dollar. It's been trying to hold the line at 160 because that's where its economy really in 1989, 1990 started to unravel. The problem is, as they sell treasury securities, get dollars, put the dollars out there and buy yen, to the extent they cannot control their currency, their inflation rate is going up. And they, like the U.S., will have a monetary decision in the middle of June, and they may take their interest rate to 1%, which is still lower than where we are at 3.75% for the Fed funds rate. But the gap has been narrowing significantly. So, and then you can see the others. Japan is in the purple there, and we just got the latest month. They sold $76 billion worth of treasury securities. You can also see China and India taking down their treasury securities. And yet our bond yields they've been holding pretty steady in this 4.4 to 4.5, 4.6% range. That's at the long end. These treasury securities are typically at the short end. But we're surprised that there hasn't been more pressure on treasury yields given how much selling of treasury securities there is out there. Now, the other thing to note is when they are selling dollars and buying their own currencies, what is really happening? Dollar liquidity out there is going up. And many people are puzzled as to why the U.S. market continues to hit all-time highs. Today, an exception, very notably. But it is, I think, one of the reasons is there is more dollar liquidity out there. The other side of this, though, and I remember this from the 80s. I was very young, very impressionable. I remember everything about it, that when we saw emerging markets especially supporting their currencies as aggressively as Turkey is right now, there were probably crises brewing. We saw it in the 80s. We saw it in the 90s with the Asian crisis. So I'm tuned into this because there could be some brewing crises out there if these countries are being forced to sell treasuries. In the case of Turkey, sell gold. We've seen Russia selling gold recently. I think this week someone within, I don't know if it was the Kremlin, but within Russia was saying, hey, we can't afford this war anymore. That to us is very interesting. And then, of course, in the case of China, China's being starved of oil. They got so much of their oil through the Straits of Hormuz, and they've had to cut back, that there may be something going on there as well that is causing some disturbances. So stay tuned for these foreign currency moves. They are important. So let's get into monetary policy. So we did fiscal policy, impact on the dollar, monetary policy now, then we'll get into economic indicators and market indicators. So here in the purple line, you can see M2 moved ahead 18 months for monetarists who believe that inflation is a monetary phenomenon. And it is to some extent. It just depends what velocity is doing around this, and we've talked about that before. So money growth seems to have stopped at roughly, I think it's 4.7 or 8% as of April, the last month for which we have data. And if you take a look at this chart, that's really in the lower half to lower third of where it has been historically. And you can see in the green line CPI inflation. CPI inflation has tended to be below M2 growth. And the reason, especially since 1997, was velocity, or is velocity, has been coming down secularly with some cyclical moves to the upside, but has been coming down. And the only other thing we can find out there that looks similar to velocity is the labor participation rate, which has come down, and it is stabilizing here. So we don't think this kind of money growth is going to increase inflation. You see the CPI here at it's in the mid threes somewhere, I think, because of energy prices recently. It was in the low threes. I think it got below 3 at one point before the Iran war. So this is definitely an impact, mostly because of oil prices. And we'll give you a sense of why we think inflation is going to come down significantly. And we really want and hope that Fed Chairman Kevin Warsh is paying close attention to this, because we are at a very important period. The Fed cannot make another mistake. The mistake, we believe, consider the source, but we believe in 22 is the Fed was trying to solve a supply shock with higher interest rates. Higher interest rates hurt supply even more. You need to encourage or incentivize increased supply in order to get more supply. So we ended up with the supply shock lasting 3 years unnecessarily. I don't think that's going to happen again, but the market is behaving, especially today, like it is. We disagree. That was a very tough period for our kinds of strategies. And given my understanding of Kevin Warsh, he does not agree with that point of view. And I think he'll pay more attention to some of these other variables. So reserves, he does believe in quantitative tightening because he worries that banks will start lending aggressively at just the wrong time. So he takes away the kindling, which is reserves. So I think we're down quite a bit. We're down since the peak 30 or 40%. And you can see bank loan officers here are on the tight side. They're tightening. It's above zero. You can see for much of the time after 2000 and after 08, 09, the Fed, the banks were pretty lenient when it came to lending, encouraged by the Fed. And as we were trying to come out of the tech and telecom bust and the 08, 09 crisis. Now what's happening is the private credit drama is, I guess what I'll say, is causing more conservatism. So we're not seeing the seeds of excessive monetary growth from the banking system. We're also looking at the yield curve, the 10-year versus the 2-year yield, we've been watching for this ever since we saw this measure of the yield curve stop at 150 basis points after COVID. We said, wait a minute, what does this mean? it didn't get back up into that 200 to 300 basis point range that we've seen in past cycles when monetary and fiscal authorities around the world have put their foot to the accelerator. It is starting to come down from a peak of 70 this time. What does that mean? Does the long bond yield see some deflationary undercurrents brewing out there? Because it's not baking in either the oil price, which you see here, up 55%. If long bond yields thought that this was going to cause a secular increase in inflation, bond yields would be much higher than they are now. If bond yields thought that this recent increase in commodity prices was going to lead to an inflationary spiral, we would not see the yield curve flattening now. What is happening here? The oil price surge, definitely because of Iran. And now we have, I think Venezuela has increased its production. In the UAE, we're seeing production going up. They've effectively pulled out of OPEC. And I remember in the 80s, in 86 specifically, when OPEC started splintering and the members started fighting and not agreeing to production quotas, Saudi Arabia said, fine, you increase, I'll increase. And it took the oil price, we had to look it up this morning, down from roughly $40 to $10. So I think, I don't think it'll be that extreme, but I think we are going to see a very significant drop in oil prices once the Iranian war or conflagration or whatever you want to call it now is over. And in terms of this, why aren't commodity prices broadly concerning the bond market that much? It is because many people understand that because of the Iranian war, manufacturers and others decided to build inventory, so they've pulled forward demand. And then there is also the supply-demand imbalance, and it's a true supply-demand imbalance. Prices going up are a signal, produce more and more and more for all of the data center and power construction going on out there. So I find that very important and interesting that the yield curve is recognizing this. This is the other thing that's happening out there, and you've heard Walmart and other companies saying, we're not passing all of our price increases through to the consumer. We're absorbing them either through higher productivity, which is protecting our margins, or taking a hit to margins. And you can see that seems to be what's going on. The PPI in green, the core PPI, has been above the core CPI now for a number of months. As you can see, that rarely happens unless we're in a recession where companies are seeing demand fall off. Well, companies have seen demand fall off as they've increased prices, and they're learning not to increase prices and to get more efficient. And so here you can see, will the core CPI fall below 2.2% this year? Now, this is probably another problem. Is this average or at any point? And we're going to get a lot better. Promise, Kalshi. So most people say no, probably because they're interpreting this as average for the year. We meant it to be at any point during this year. And you can see we're already down to 2.8%. You know, the oil price impact getting into finished goods, other than gasoline, just hasn't had that much of an impact. And we do think that this will reverse and could get below 2.2% this year. And here's one reason. So this is Trueflation. We've been featuring this every month. Trueflation did tick up because of the oil surge, but look at it. It didn't get back to where it was, and it is rolling over and is back below 2%. Even more important, the core trueflation measure, and this is consumer price inflation, is at 1.2 or 1.3%. And really, you can see it has broken down. So we believe that the surprise in inflation this year is going to be much lower than expected inflation, and maybe a very rapid deceleration in inflation once we clear through the Iran war. Now, here's another reason we expect inflation to be much lower than expected. Productivity here, 2.8%. We think that it's going much higher. And I think the most astonishing number for me among the charts, sometimes I need this perspective and love doing these monthly calls as a result, but look at unit labor costs. They're roughly 0.5%. And what that is saying is productivity is offsetting most of the compensation increases out there. And you can see how different this is from the early 80s. And if you were to go back to the 70s, you'd see that double digit territory for unit labor costs, because we were in cost push inflation back then. Oil prices kept going up and up and up, and unions were striking, and workers were just saying, I'm quitting, I'm going on to a higher paying job. So to prevent turnover, they had to keep pushing compensation rates up. That's not happening now. In fact, quite the opposite. Many people are fearful that AI and robotics are destroying jobs, and they're not as demanding when it comes to wage gains and so forth. So here is what is happening to corporate America. So this is non-financial corporate revenue growth on a year-over-year basis. That's in the purple, versus private payroll employment. Now, typically, private payroll employment growth year over year, when it's going down, it's because revenue growth is decelerating. That's not happening now. This is unbelievably good for margins. And so you can see these are domestic corporate margins. This is as a percent of, domestic corporate profits before tax as a percent of nominal GDP. So that's the equivalent of U.S. revenues. And you can see we're heading up towards all-time highs. And a big part of the reason for that is revenue growth accelerating, employment growth not, productivity gaining. And, of course, AI is a big part of that story. Now, this chart is also quite astonishing. This is labor, compensation as a percent of nominal GDP. So this is the flip side of profits. Corporations' profitability has been going up as compensation as a percent of GDP has been coming down. Now, this is what I think is going to change. I think the big surprise in the next few years is going to be labor shortages, not a glut of labor. Now, I know that corporations are not hiring right now. At least it's much lower than normal, but they're also not firing. And in the meantime, and as I've encouraged anyone who loses a job or can't find a job, just go out and start a company, solve a problem with AI. I do think there's going to be an entrepreneurial explosion, and corporations, larger corporations who want to attract labor are going to have to change this dynamic. Because let me tell you, while I did start my company at the age of 57, and I wish I had done it much, much earlier. It is the most satisfying thing. It's also terrifying. It's exhilarating. It's all kinds of emotions. But, it's the real American way. And so I think corporations are going to have to compete for talent. And the talent is going to lean towards becoming entrepreneurs, self-employed. And I think they got a head start of it, or at it, in the internet age. Influencers, a lot of those people have quit their jobs, and AI is making that even more lucrative for them. So I think we're going to be talking about labor shortages, or certainly corporations will be, which will increase their need for productivity growth as well. Here is household employment. This is on a 3-month moving average basis. It's year-over-year percent change. And you can see household employment, which does include small businesses, is declining. Now, you can also see from the shaded areas, rarely do we see a decline in the absence of a recession. And yet here we are. Now, in this month's employment report, which was a barn burner, expectations, I think, for non-farm payroll employment were 88,000, an increase of 88,000. The increase was 172,000, and upward revisions to previous months, 93,000. And yet wage gains, 0.3%, very well behaved. If you annualize 3.6%, and we're at roughly a 3% productivity growth rate, that's how you get to unit labor costs down at roughly 0.5%. Household employment in this last month, this is a 3-month moving average, month to month, they were up about 155,000. So for the first time, in past employment reports, I usually say something for everyone, bears and bulls. This was just bullish. And so I think it's telling us the economy is doing very well. Here you see the labor force growth rate. Again, 3-month moving average, down year over year. And you can see it's even more rare for this to happen in the absence of a recession or the aftermath of a recession. And it's happening now because baby boomers are retiring at an accelerated rate. I've seen some individuals out there, we've moved into the AI age, and they're basically saying, okay, I'm out of here. I'm not doing that. So maybe that's one reason we're getting a turnover in the labor force here. And in order to pull more people into the employment ranks, corporations are going to have to bid up as baby boomers retire, and as we lose people who are leaving the country because of the immigration crackdown. Here is the chart we've focused on quite a bit in recent months. The top one, you can see the unemployment rate for young people, 16 to 24-year-old, is at 9.4%. That is very high. It's almost double the overall unemployment rate. But if we're right and young people say, to heck with this, I'm just going to start my own business, and in doing so, showing their initiative and doing it with AI, becoming more attractive to corporations, they're probably going to be able to demand more compensation. So we think that's going to happen, and that this unemployment rate will continue to come down. Here's consumer sentiment, record-breaking low. And it is heartbreaking. I think there's so much fear about employment, and I've just told you what I think, which is contrary to conventional wisdom out there. But there are other reasons that consumer sentiment has been weighed down. Fears from an employment point of view. Their saving rates going down. And now those who are living hand to mouth, they have no choice but to take any savings that they have down. Now, savings can go down for another reason. It can go down because the stock market's going up. You saw that in the 90s. The stock market's going up, and typically confidence is going up at that time. It isn't yet, but it could be the reason at the upper income level, the saving rate might be going down. You can see what's going on at the lower income level. That auto delinquency rate, we've been watching it for a while, it's blown out, above 0809, above COVID. And so what we think could be happening is people are quite happy to let go of their cars now. They can get an Uber if needs be. They'll work remotely, and it frees up some income. So that may be one reason they don't mind losing their cars. On the other hand, you see credit card delinquency rates improving. What's this? I think young people especially are paying a lot of attention to their credit scores. And I also think that tax refunds in the last year have offset the impact of oil price increases. So this is good to see. Here's consumption. It's held up pretty well, although I think we'll see this roll into a little bit of weakness because in the last few months, and not recorded here, inflation kicked up directly because of oil. But nonetheless, it's still holding up. Given that kind of sentiment, it's holding up. It's okay. And one of the reasons sentiment is down is, again, I'm going to blame this on the Fed circa 22. Basically, the Fed shut down a generation of homeowners. You know, the young people cannot afford a house. They've got their student loans. They've got the housing prices went up during COVID. Now they're settling down, but they're not crashing. So we still have the affordability issue, and you can see where existing home sales are. They're back where they were. Well, I don't know how far this goes. I can't see it quite. But in the 70s, when I was in college, I remember this number being above where it is now. I remember it being in the 4 to 5 million unit range. And the population is so much bigger now. So that's been a travesty. And I do believe Kevin Warsh is taking due note. He knows that interest rates have to come down, mortgage rates at least. And if inflation comes down as productivity is increasing, no matter how strong the economy is, I think he will cut rates. Now that is contrarian, I know. But that's what I do believe about Kevin Warsh. Here you can see, home buyers, that's in purple, home sellers, just tremendous imbalance. There's a lot of angst out there. And I would put that in the baby boomer category as well. They don't want the big houses. They want to move, but they can't afford mortgage rates that are twice what they have right now. Here we have the interest rate. As you can see, it's ticked up recently, so not inspiring confidence and not increasing affordability. Now, on to the rest of the economy. So that's the consumer and housing, and those two are very related in terms of sentiment. Here's the just in case. Just in case the Iran war happens, boom. Just in case we run into another supply shock, I am going to build inventories. We think that's partly what's going on here. And then, of course, the other big development, continuing development, is the AI infrastructure boom. And it is creating a ripple effect throughout the manufacturing sector. Here, as you can see, we've broken out of, in the tech and telecom bubble, we went to a high, and we had trouble breaking through it until recently. And now we're out. If this were a stock, you'd say, we've broken out, we had a little cup and saucer, or whatever that would be called technically, and we're on our way. We're on our way. Because, why? Because this investment is paying off amazingly. So XAI, now SpaceX AI, has, to the best of our ability to discern this from SpaceX's S1, Brett Winton has done incredible work on this, as well, along with Frank Downing and Joseph on our AI team. We believe that SpaceX AI built Colossus 1 and 2. I'm not going to get this exactly right, but for roughly $30 billion. And Anthropic is renting it out effectively for $1.25 billion per month, $15 billion a year. And the numbers may be even higher than that. So think about that. They invested $30 billion, and Anthropic is, in 1 year going to return half of that investment. That's mind-blowing. And so that's why I think that SpaceX AI was willing to rent it out. Anthropic was willing to pay, and XAI is reorganizing and restructuring. Here you can see tech spending, comparing it to where we were in the tech and telecom bubble. This is what scares a lot of people. We're almost there. And this is on a metric that Will Share, who put together this chart. It's around very tech-specific categories, hardware, software, maybe R&D as well. So we're up there, and yet we think we have miles to go. In the Industrial Revolution, CapEx as a percent of GDP went to somewhere in the 5 to 6% range. Right now, we are we're less than half of that, maybe the 2% range, and we think we could go into that 5 to 6% range. So don't let the tech and telecom bubble and bust scare you. That was too much capital chasing too few opportunities too soon. We didn't have the cloud, we didn't have the breakthroughs in AI, and everything was way too costly. That fiber laid stayed dark for decades. The GPUs today, as someone said, I don't know who said this, they're melting. They're in such short supply. Trade deficit, just to round out consumption, investment, inventories, and trade. That's what makes up GDP. You can see pretty much status quo. At least it's not getting bigger. I think that would light a fire under President Trump's rhetoric on this particular topic. We would not be surprised to see deficits get worse. And as I've said, we don't worry about it because the other side of a trade deficit is a capital surplus. It all works out. We see a lot of capital inflows into the U.S. Here, we're on to markets, and fascinated by this chart still. The gap that opened up. And I think this, when history is written and has enough hindsight, we'll look at the 2022 rate hikes as, a massive mistake. It caused a lot of harm. The metals to gold ratio in the green there went straight down. It is now starting to recover. That's good news. It's consistent with the economy starting to recover. As you can see, interest rates have pretty much been range-bound in the last few years, despite some of the charts I showed earlier in terms of the disgorgement of Treasury securities around the world. And they're buying gold. If we're right, that's going to be a major mistake because if you'll notice, the day that Kevin Warsh was appointed, that President Trump appointed Kevin Warsh, the gold price peaked. And I do believe that Kevin Warsh, just like Greenspan, will keep a very close eye on gold as an important inflation gauge. Here, S&P to crude oil bouncing back. This is very reassuring. You saw what happened in the 70s. It absolutely imploded, and that created a bear market that lasted from 1966 to 1982, and you can see we're not continuing down. We're moving in the other direction, and we think that will continue, especially if we're right on oil prices. Here is the S&P to gold, and again, I reference this because I respect GovCal, a research house out there. They tuned us into this many years ago, and you can see again in the 70s what a disaster. You can see we're stabilizing here, S&P picking up relative to gold because the S&P is going up and gold is going down. We do think that's going to continue today, notwithstanding, if we've got Kevin Warsh right, and I think we do. Here you can see Bitcoin to gold. This one isn't as clear-cut. There's been a lot of fear around quantum computing, around Michael Saylor selling, many people saying, oh my gosh, his debt to asset ratio or debt to market cap ratio, I think, is in the 40-45% range. He may be forced to sell more and more Bitcoin. We shall see. We shall see. As I said, we think gold will continue to come down, so that will put upward pressure on this ratio. And as far as Bitcoin, there are a few on-chain indicators that are saying the bearishness has reached an extreme. We shall see. We shall see. Maybe this is going to be a test. Here, two more charts basically saying not a care in the world. And you know what? If we're going into a boom, that's right. These credit default swaps, bank credit default swaps, should be well behaved, as should junk bond yields. So these are the high yields relative to Treasury yields on the 10-year spread, and you can see very quiescent. You can also see, and we always have to be on guard, that they're quiescent until they're not, until there's a major shock. That's why everybody was worried about the private credit meltdown. We have not been worried about that. We think it's isolated. It's not hitting the banking system. And so we feel pretty good about that. Just two more charts here, courtesy of Kalshi. So this is their new American Power Index. So Kalshi, wisely, is starting an index business and hoping that their index become important reference points for traders and increase the liquidity of all of their markets. So this is the American Power Index. Now, given how much power is in the news around data centers, I don't think I would have named it this, but it is the balance of power here that they're trying to get at, Republican versus Democrat. And I was astonished to see that this is flipped toward Republican. When the Iran war started, it went negative, and now it's come back. And I do think the stock market has had something to do with that, and a lowering or a lessening of the incredibly difficult rhetoric around the beginning of the war, and an iteration towards hopefully some kind of deal. So that's interesting, especially important in this midterm election year. And this is another chart or market that we suggested to Kalshi. When will Compass Pathways submit an NDA for Comp 360 psilocybin for treatment-resistant depression? And what's interesting about this is where there are inefficiencies in these markets. There are so many positive signals here. This started in March. This contract did before the FDA, or before the president's executive order on April 18th, I believe, to expedite the approval process for psilocybin and other psychedelics for mental illness. And it also, there was the FDA also cooperated in essence by taking the approval process or the length of time from 10 months to 1 to 2 months. So we thought all of these would go up, that the odds of all of these would go up dramatically, but they've hardly changed. And amusingly, the before January of 27 is higher than the before April of 27. How can that be? So we're all getting used to these new markets. I'm enjoying it. I think it's bringing back active management because we'll be focusing on the variables that are most important to stock moves and hopefully getting away from mindless algorithmic trading around macro variables and others. Let's just get down to business and what really matters in terms of company by company. So with that, I know this was a long one. We feel very strongly about who Kevin Warsh is, what he believes. We don't know how strongly he will feel about bringing along consensus before he says anything. And so that's what the market's grappling with. But truth will win out. We do think he will be a strong force on the Fed. He'll be very convincing. He's very good debater. And I think that his appointment and confirmation bodes very well for monetary policy here in the United States, done correctly, and for financial markets generally. So with that, I will leave you and wish you a happy official beginning of summer later this month.